Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. Y'all know that drill. Smash that like button, subscribe if you haven't, and just remember the disclaimers below. Nothing should be construed as financial investment advice. These are just my opinions, thoughts on the market. I'm not a financial advisor. Don't consider me as one. Let's get into today's stuff. I have my in-laws in town, a lot of things going on, so I'm just a regular dude like you, so it's hard for me to get like every Tuesday, every Friday, I don't do this for a living. I actually have a job and a lot of other things. So I will try to keep updated and everything, and that's what I'm doing. So what interests me is this Global Markets Investor article. Chart of the week. US investors, this was in September 6th, are all in on stocks. So let's look at this investor allocation to equities, all-time high. You look at this, 55%, 17% is the debt, meaning bonds, 13 to cash. According to this source, Federal Reserve, Goldman Sachs, whatever. So, and cash allocation is near an all-time low. Lowest since the 1980s. So, I mean, the 1980s was the beginning of a bull market. So that doesn't necessarily mean that stocks aren't going to go, but generally speaking, when allocation to equities are at record highs, generally there's very little left to buy and a lot to sell. A lot of people potentially selling. So we'll see what happens. I don't think anything's going to happen this year, but let's go. Another thing that got me, and this is one reason they have to be more honest with the data. Despite Trump firing the head of BLS, look at this. Dollar store draws more shoppers making six figures as Americans across income levels look to save. Of course, why are they looking to save? Because they're expecting a rainy day. I don't know exactly why. Maybe they see their neighbors getting fired and they're like, oh crap, I got to start saving more. Or maybe they see family members are both getting fired. Or maybe they've been threatened at work. Or maybe someone's like, hey, we might have to do layoffs if we don't have a good quarter. So they're thinking, oh no. So who knows what happens? But look at this. Sales at Dollar Tree and Dollar General grew in the most recent quarter, with these increase powered by higher income shoppers shifting to spending at lower cost alternatives. Look at this. While sales was strong across all income cohorts, we continue to see especially strong performance from middle and high income consumers, Dollar Tree CEO. So you're seeing that the upper class, this is why I told you this is not a two-tiered economy. It is knock out the weakest links first. It's like, for example, let's pretend you're in a fight and you knew someone had a bad shoulder. And it's like the scouting report is, yeah, this is a two-tiered fighter. Like he has a bad shoulder and he has a bad shoulder, but everything else is healthy, so he should be fine. And what are you gonna do? You're gonna hit the shoulder. Eventually, everything else is gonna fall with it. You're only as strong as your weakest link, and that's what it is. And then eventually, the shoulder gives out. Person can't fight anymore. So anyway, Dollar Tree said customers with salaries of more than 100K made up 2/3 of its new customers in the second quarters. So there you go. Pretty soon, you're going to see the millionaires and billionaires shopping at Dollar Tree. Peter Schiff, years ago, when I used to follow him, said, we're going to see a term called broke millionaires, and we might be there soon. So remember that term, broke millionaires. So, so yeah, Dollar Tree, Dollar General, You look at it, it's the higher income. And I talk about it's not just Dollar Tree and Dollar General. If you look at my past videos, I talk about Walmart, among others. Trade-in, what company calls higher income shoppers swapping out dollars spent at higher cost retailers and spent at Dollar General. So there you go. You can tell, and I think the jobs numbers, even though it was positive, was way overstated. So we'll get to that. Speaking of the AI bubble, Goldman wants to really remain credible. They're now issuing Goldman Sachs a warning to AI stock investors. So, and this is interesting stuff that they were doing. I'll get into it. When I was reading this, I was like, wow. So AI investment as percentage of capex could be nearing a climax. It turns that sets the stage for overly upbeat AI investors to be let down if earnings don't come in strong for future quarters. Well, yeah, this is a bubble. Everyone knows it. I mean, not everyone. Maybe everyone listening to this channel knows it, but and so investors they're asking where, their overly optimistic expectations, prices of these. So, and they said, I mean, Nvidia reassessed company's quarter outlook and down 6%. So Salesforce and Figma got drilled Thursday after their earnings reports didn't wow. It's clear that the hype on their earnings calls wasn't enough to paper over the soft areas of the earnings report. Growing concern on the street centers around the pace of AI demand by corporations, given what looks to be slowing U.S. economy. Of course, when it comes to AI, who's gonna buy this? Everyone's losing their job. Like, how are they going to profit? You have to have revenue. You actually have to have people. Are they literally going to start killing off people and having a robot induced Earth? I mean, that's what it sounds like because if people don't have jobs, you can't use this AI. And then look at this. This is what I sound crazy. In this market where you have companies trading at 100 times revenue, not earnings, revenue. You have companies trading at $500 billion valuations that lose 10 billion a year. I mean, I've seen this story before. I lived through the 90s bubble, tech bubble. Now, I wasn't like a trader or investor, but I was alive for it. A lot of these AI companies, they might go out of business. I mean, 90% of them. So, I found this interesting. Of course, they say, Hammond and AI, its valuations don't appear in bubble territory. Meanwhile, how is this not a bubble? Companies trading 100 times revenue, $500 million valuations, and are losing 10 billion a year. How's that not a bubble? How is that? But then they come assure valuations don't appear in bubble territory. They contradict themselves. It's unreal. So anyway, see, AI is having its problems. Uh, and then here, let's talk about the jobs numbers. And look at this. Job numbers seals Fed rate cut. You listen to this channel, I said they're going to cut rates. They're going to go back down. And the thing is, the problem in this market, they need to go back down to zero and they need to start doing QE. But they want to do it slowly. Weak jobs reports Friday sealed the fate of interest rate cuts. I think he's going to do a 25 basis point. I don't think he's going to do a, we'll see. They say that's a hawkish cut, but let's see. Look at this. Balance of risk appears to be shifting. I think they might do a 25-point rate point and say there's room for further rate cuts down the line. So I don't, what really got me is I think this is the most honest. Job growth for June was revised into negative territory. So, and if you ask me, I think every month this year should have had negative job numbers. So June is the most honest month in in this year, the year 2025. Yes, 2025. So here it is. The question of a cut is no question. There is going to be a cut, whether it's dovish or a hawkish cut, which is absurd. There should be no such thing as a hawkish cut because inflation is rising rapidly. Every cut should be dovish. It should be just how dovish. And this is what, if they cut rates, this is what we call stagflation. We're having a declining asset market and higher inflation. So that's what it is. And if you look at this, the economy's so bad, I don't think they can even pretend because they always lie and make up good, positive job numbers. I don't even think they can pretend the economy's good anymore. And that's going to hurt the markets. I don't think there'll be a crash. There will be a crash soon. I mean, when I mean soon, I mean in the next couple of years. And it's going to go into a multi-year, even 1 to 2 decade bear market. Now, you never know. It might be one of those like 2000s where the Dow made a new all-time high in 2008 and then it crashed and finally got lower. How it's going to happen, no one knows. But these are a couple of things I wanted to get into also. U.S. hotel declines, hotel market. Now, if you looked at my past video, I talked about the rise of hotel living, which really flabbergasted me. And now people, because they don't have the credit to secure rent or they don't have the income, what they're doing is they're doing a lot of extended stay hotels. By the way, if you're still listening, hit that like button, subscribe, and remember the financial disclaimer, not to be construed as financial investment advice. I saw someone on YouTube do that in the middle without the financial disclaimer, but New York, Los Angeles, Chicago, San Francisco, they're seeing growth. But the rest, and if you look at it, this is where the real high rents are: New York, LA, maybe not Chicago, but San Francisco. So a lot of these hotel growths in these three states, they're probably people living there now. They're probably not people like going on vacation, having fun. They're probably people living there in extended stay. But the U.S. hotel market as a whole is in decline despite more people living in hotels instead of renting. And why do they have to do this? They have to do this because one, they don't have the credit score to secure rent, or they don't have the income. So they have to get an extended hotel. And they were saying, like, at least we get fresh linens every day, we get free utilities, and they probably have, a hotel breakfast bar. And so they can eat there, they get a free breakfast. So there are things that help them. Look at this. Hotel industry experiencing a slight downturn in its performance. Now that's July 2025, but I think it's uh this is a 1% decline compared to last year. So this is a cooling demand despite more and more people need these extended ones. And of course, they say New York City has the highest occupancy rate. Well, that makes sense because they have the high cost of living. So getting rent there is probably super expensive. So a lot of people are probably going to those motels and extended stays. So New York City would actually be the one where growth, because people are they're not going to hotels for the right reasons. They're probably going to the hotels for the wrong reasons. That's people are living there. They're extended stay. They need a place to live. They don't have a good family. They don't have parents to come home to. They can't get rent. They can't buy a house, but they don't have the credit or income. So they're doing these extended stays on the hotels. And then New Orleans and Phoenix, this is where the housing market's really declining. So the South, the Sun Belt area. So yeah, people probably, rents are coming down, so they don't need these hotels. So Yeah, so this makes completely sense now that I learned. That's the one thing I love about this is I'm learning every day on this. Look at this. Despite recent slowdown, they're showing signs of resilience. Yeah, people with bad credit ratings need so yeah, look at this. LA, Chicago, San Francisco. Of course, Chicago has high property taxes. They have very high property taxes. And I was even talking to my friend Rahul. He said you can get an extended stay for $65. So it's not really all that, much different from rent. And then you get the free linens, maybe you get a breakfast bar so you don't have to go grocery shopping as much. So you save there. You get the utilities. You don't have to pay for any utilities, water, electricity, Wi-Fi, any of those. So of course, they say attract business and leisure. No, it's attracting people with bad credit. So, see, the press, you can tell right here, travel around the world. They don't tell you. That's why you got to subscribe to this channel so you know what's going on. New York City's dominance. Yeah, well, people can't rent there. So there it is. Of course, they don't talk about the extended stay. That's why even when you go to the most highly travel world, tourworld.com, they don't talk about it. So anyway, let's go to, I said in this channel, we're not, manufacturing isn't coming back. The manufacturing sector remains in recession. And the reason why I say that is not any ill will, but if you want to bring it back, you have to crash the housing market and you have to crash the equity markets and bring down the cost of living. And they're not willing to do that, especially with the boom. The reason the housing market is mainly the older suburbanite population. They're really to blame. Everyone likes to blame the Fed, the stock market, the Fed, the government. Those are easy targets. And no change will ever occur if you don't really point out. But that's why. And they're the voters. They're the people who fund the campaigns and they're funding the politics. So not going to happen. Manufacturing, maybe in 20 or 30 years, the U.S. will bring back manufacturing, but it's not right now. And so, as you can see, we're in a manufacturing recession. Let me see. They don't even really give. This is what annoys me. Sometimes they don't even give good things, but. So yeah, a lot of it, the manufacturing numbers have really been abysmal. So one of the longest manufacturing recessions in history, but not the deepest. So anyway, let's go into a couple other things I want to get into. I'm going to see if I can. If you look at gold, let's see. Don't worry if you don't see any chart. I'm going to share my screen. I'm just trying to search. So here it is right here. If you look at gold, it had a great day. It was up $40. Silver up 35. So it's getting to my target of around 50. I want to see if it breaks 50. I think if it breaks 50 and goes through, this might be it. We might be talking at the end. Now, I don't know exactly what happens. So what I think is going to happen with this rate cut is they're going to cut rates and inflation is going to go astronomically bonkers. You're going to see prices double from here, meaning this is the base. And I think they're going to be forced to fight inflation, and they might even unknowingly crash the equity market, and that might be the beginning of a bear market. But I think gold has one more leg, and that could be at the cut rates, inflation goes up, gold really goes up, and then they say they're going to fight it, and that's when they get in. So I think we're going to get to the point where they'll be trailing losses or not. And this is one reason. I remember one guy, I'm not going to say exactly who he is, but he was talking about life-changing gains and you can quit your job and whatnot. And he says there's one more leg up. But if that's true, like gold goes to 3,900 or 4,000, and then it becomes to a multi-year bear market, which I think will happen. And then there'll be another bull market. This run hasn't been life changing. It's made people a lot of money and gotten people a lot of debt, but it hasn't been life changing. You haven't seen $1 stocks go to 30 or whatnot. And this is the one thing I always say when I say I'm not a financial advisor, I don't mean it. I point out where the markets are, but anyone that's saying life changing events, it was iGold. It was the company that talked about life changing events. They're BSing you. Like, very few people get life changing gains, and the ones that do, they get inside info. Probably that's probably what it is. They probably get massive inside info. So always be wary of. I will never. I don't even promise gains or performance. Honestly, I always say these are just my opinions. I can't promise performance or gains. These are just my opinions on things, but I give you my opinion. I tell you where I think it's going to go. It doesn't mean I'm right. Um, I would say for gold, I've been pretty spot on. Stock market, you don't see me predicting now because it's sort of been oil and energy. I can't form an opinion, so I'm not really. I think it's cheap. I think oil's cheap, but when it's going to move or not, I don't know. It's so manipulated. Oil, it's so like most oil is controlled by governments, and they might increase production to bankrupt another government or decrease it to help tax revenue. They do that all the time. It's hard to predict. It's not a market. It's not a free market, at least, or nothing's a free market. Nothing's ever been, but there's no semblance of one anyway. So, but gold and silver, I think silver, you look at it's 41.05 is up 38 cents. Let's see where it's been. This silver chart's always been the weirdest. Like if you look at it, it still goes up. Like the 30-day chart was at 38. Now it's at around 40 something. And look at it, 6 months start at 32. Now it's at 42. It went down a lot to below 29. Then it just came up. If you look at it, breaks. It's really a weird trend line. Like really retested, but then now it became resistance. And I don't know. It might, if you look at it, I don't know. I don't know how to exactly draw a trend line from there, but it keeps making, like, if you just keep going, it keeps making tops. I'm not a technician, but it could break that trend line and then go, that could be the final straw. Let's look at there's no point in a 10-year, but look at the 5-year. It's really gone up. And if you actually look at it, the base is around here. But if you actually look at silver's base, it was around when it broke out, it was around $9. Now the base is around 20 or 25. It's like 19 to 25. So I think it will break 50 this time. But we'll see what happens. I'm at the point where I'm almost doing trailing stop losses, where I'm actually thinking about it in my own portfolio. If you actually look at the S&P, it looks like there's a room. Like yesterday, down 20 points. 5 days though, it's up. A month, it's up. 6 months, year to date, 1 year, it's still going up. I think it's due for some sort of decline. I could be wrong. The economy is looking horrible. Let's look at the U.S. economic data. Like, and I'm talking about even bad by government numbers. I'm not even talking about uh I'm not even talking about just bad in general. Like I'm talking about even like job openings. That was horrendous, way below the consensus. Factory orders were negative. Job cuts were high, way higher, a little bit below the forecast. ADP employment was horrible. Trade deficits were skyrocketing. Jobless claims were more than expected. Uh, ISM PMI was actually good. But even looking at the non-farm, that was 22,000. And that was just not. So payrolls for June were revised down by 27,000, and July was revised up 6K. And then with these revisions, employment for June and July combined for 21,000 lower than reported last month. So, I mean, the stock market I think will go up because I think there'll be a rate cuts. I think this might be the last sort of run into 2026 or 2027. It could be coming up soon. I don't know. Just my opinions. I'm not a financial advisor and I'm not a prophet. I can tell you that. So just whatever you do on your investing, make sure it's yours. I'm probably going to start looking into what one person said is that it's forming some sort of triangle on the, which is the another breakout where gold could be to 38 or 3,900. I think silver that will start breaking 50 and go up, and that could be the last run. I sort of agree with that, even though I think they're that person's a little full of it, full of himself or whatnot. I actually do agree, and silver will break 50. There'll be one last hurrah. If you actually look at the Huey, let's see if we can get the Huey Gold Bugs Index. This has really come to my attention. I'm going to try to do max. This goes back to 2011. But that was around, the top was around 628. It's at 537. This could be, making a breakout. Or maybe it goes to 627 or 628. Maybe it has 100 more room. And look at that. It might form a cup, and then there's a multi-year bear market. And then the gold stocks form a handle over multi-years, and then there's going to be another breakout. So you never know. Like this looks like a cup forming, but this is over a 10-year period. And then I don't know if this is a cup. I'm not a technician, so I could be wrong. But to me, it looks like it could form a cup, go back to 628, and then multi-year and then there could be a multi, but it's not like a pure cup because like it goes down, goes, and then it's up. Like from 2015, it went from 116 to 267. Then it broke to 317. And then see, it came down and started breaking out. So, look at it on a 5 year. You can just tell it's coming. Broke out on a 5 year. 1 year, it's still in an upswing. So, year to date, still in a really good upswing. So, just remember, I'm not a financial advisor. So, investing involves risk. So, thank you for listening. Hit that like button if you listen all the way through. Subscribe. And I will see you next video.